Hello, everybody. My name is John Snare, and I am very happy to be once again participating in Albert's School of Business annual Ethics Week. This is probably the third or fourth time I've spoken to a class, and usually been in an investment class, and happy to do it again. Hopefully I can share some of my insights into ethics in financial investment markets, based on my 30 years of experience, and watching what's gone on over the years, and um, kind of making some observations about what I think has caused some of the scandals and the problems that happen in financial markets unfortunately on a fairly regular basis. So right now I'm the managing partner of a wealth management firm in Bellevue. I opened the office here for a firm that's based in Silicon Valley. It's called Bordeaux Wealth Advisors. Before that, though, I was with Wells Fargo for 14 years, and as many of you have probably seen, there's been some scandals and issues with Wells over the last 5 or 6 years, and I'll talk about that a little bit and what I think happened there. And I'm also an adjunct faculty member at Seattle University. I've taught I think 3 or 4 investment classes in the graduate program in the business school. I have not taught since December of 19 because I've been starting this new business, and my other talks on as part of Ethics Week were in person, and so this is a little bit of a new experience for me, as I'm sure it is for all of you, to do this via video, but hopefully it'll work. I have been involved in financial markets and investment management since the early 1990s. And over that time period, there unfortunately seems to be some sort of major scandal, every couple years around things that have gone on in financial markets that in many cases were illegal and unethical. And in other cases, I think people didn't set out to do things that were illegal and or unethical, but because maybe of a lack of understanding of what they were getting themselves into, ended up doing things that were illegal or changed the environment so government regulators made them illegal in the aftermath of what they had done. And so I want to talk a little bit about some of those scandals and generally my observations of what caused the issue and why it was that these have happened. Like I said, I'll talk a little bit about Wells Fargo and the experience I saw there. And then your professor has told me that one of the things that you cover in the current class you're in is derivatives. And I think it's interesting that there's been a number of these scandals that have kind of resulted from, I think, people not understanding what they were getting themselves into in various kinds of derivatives and the blow-ups that would happen because of that. So the first one I wanted to talk about was going back to the early 90s, following the recession in 1990-91 after the first Gulf War. Interest rates in the United States went down dramatically as the Federal Reserve tried to combat the recession and get the economy growing again. And because of those very low rates, lots of investors were chasing yield and trying to get better returns on fixed income investments, really similar to what we're seeing right now. And one of the things that happened back then was that there were a number of fixed income bond managers, both mutual funds and other types of funds, that started using derivatives to kind of juice return within their funds. And they bought derivatives based on the assumption that interest rates would stay low or maybe even go lower. And for a while it worked. There were a couple mutual funds that were kind of the number one ranked bond mutual fund in the world because they were buying these derivatives that increased their return. Even though they were essentially government bond funds, and they were making 2 or 3% more than everybody else in their competitive universe, which should have caused people to ask, well, if you're just buying treasury bonds, how are you doing so much better than everybody else? Well, what ended up happening then in 1994 is the Federal Reserve kind of unexpectedly started raising interest rates, and they did it several meetings in a row through 94 and into 95. And what happened was a lot of those derivatives that were being held by some of those funds essentially blew up because they were based on the assumption that interest rates would go down or stay low. And when interest rates went up, those derivatives that those funds were holding went down dramatically in price. And several mutual funds basically had huge losses in funds that were supposed to be low risk bond funds. And the most famous case was the treasurer of Orange County, California, had invested county assets in several of these type of funds. And the end result was Orange County, California had to declare bankruptcy. If you know much about Orange County, it's one of the wealthiest areas in America. It was then, and it still is. And it was just sort of ironic that they ended up having to declare bankruptcy because of these derivative losses. And, again, I don't know that the treasurer there set out to do anything wrong. In fact, he probably thought he was doing the right thing and making money for the county, but he was investing in derivatives that he didn't really understand or didn't understand the risk of what he was entering into. And when markets moved against him, he lost money for the county very quickly and in a very large amount. And I think that's one of the underlying problems with derivatives is that they are an extremely powerful and valuable tool for sophisticated investors and managers to manage risk, to hedge risk, to take positions that will improve their balance sheets. But just like any hedging tool, people can also use them to speculate. And when you speculate and you don't truly understand the risks that you're taking, or you do understand the risks, but you think that you kind of know better and will be able to deal with that. And then when markets move against you, that's when you pay the price, and huge losses can occur very quickly. One of the really recent news stories was about the blow up of what gets called a hedge fund by the media, Archegos Capital, which is based in New York City. It's not really a hedge fund. It's a family office, which is a private organization that theoretically manages money for just a particular family. And the man that set it up was a former hedge fund manager who basically retired from investing other people's money and was just investing his own money. And what he was doing was taking very large positions in just a few stocks through the use of a vehicle called a total return swap. And a total return swap is an agreement that an investor will enter into with usually an investment bank or maybe another hedge fund that says that they will pay a certain level of interest rate or fees to the investment bank in return for that bank buying particular stocks for them. And then whatever the return is on that stock, they basically swap the returns. So when the stock goes up, the investment bank will send money to the investor, but if the stock goes down, the investor has to then send money to the counterparty of the total return swap. And the reason why I think people think that he did this was so he could take really big positions in a few stocks without it becoming publicly known that he was buying them, probably to avoid having to register with the SEC that he had more than a 5% or 10% position in some of these stocks. Like Viacom, I think was one of the ones that he was entering into. And like any derivative, there's tremendous leverage that when things go well, you can make a lot of money, but when things move against you, you can lose a tremendous amount. And according to some of the stories, he lost maybe up to $10 billion within the course of less than a week. And the counterparties, particularly Credit Suisse and Nomura Securities, who were the counterparties on these credit default swaps, didn't fully understand the exposure that they had. And he was entering into swaps with multiple different counterparties, and they had no way of understanding that he was doing the same thing at 5 or 6 different places, and the amount of exposure he was getting to particular stocks. And so they couldn't manage the risk very well. And so, just this week, Credit Suisse took a $4 billion loss on their quarterly earnings, and the person who was in charge of the prime brokerage unit and the investment banking unit, I think, both got fired. Regulators are probably going to look at this again. After the financial crisis, there was a law that's commonly known as the Dodd-Frank Act that got passed that really expanded the regulation of a lot of things in financial markets, but particularly swaps. But for whatever reason, whether it was lobbying by wealthy people, there was generally an exclusion for family offices, since they theoretically were not taking any outside investor money and they were supposed to only invest in conservative investments, that they didn't have to report their swap positions. And the Archegos story will probably make it so that there'll be new regulation that results in family offices probably being more regulated than they were under this earlier exception. So, when you look at these situations or these news stories and scandals around derivatives, again, I don't know that it is because people set out to do something illegal or unethical. Bill Huang, the man who owns Archegos, he essentially, all the money he lost was his own, although the stockholders at Credit Suisse and Nomura Securities probably don't think that, because those companies took pretty big losses. But I think there is an ethical standard that if you're going to invest in derivatives for other people, if you're a fiduciary that's in charge of managing other people's money, I think you really need to understand what you're getting into and have very rigorous risk management structures in place to prevent those types of blowups. The other type of scandal that has occurred fairly often over the years that I've been observing is not really dealing with derivatives, but I think just what looks like fundamental dishonesty by different investment managers. And again, one of the recent stories was last week, Bernie Madoff died while serving a 150-year prison term for his role in basically the biggest Ponzi scheme that the world has ever known, in his what was known as Madoff investment securities, where on the surface, Bernie Madoff was a very reputable, well-known Wall Street executive. He was the chairman of the NASDAQ stock exchange for a number of years in the 90s. And he owned a business that had two components. One was a market-making operation that was well respected and did business on Wall Street for many years. And then he had an investment management group which he kind of ran on his own in a fairly secretive manner. And for years, he would report these results that were remarkably consistent. Just year after year, he would return 10%, and he would do it with what was seemingly very low risk. And whenever anyone tried to kind of delve into what he was doing, he was very secretive, like many hedge fund managers are. I wouldn't really say what he was doing. But how it was discovered and how this happens very often is when markets crash, when there's a big downturn in the market, you often end up finding out who was doing things kind of in a questionable manner when stresses of the market hit their portfolios. And what happened is, because even during the financial crisis in 08 and 09, he just kept reporting these very steady returns, and investors who were losing money other places started asking for their money back. And that's when it became public knowledge that he was essentially, for years and years, running a Ponzi scheme where he would take money from investors and use it to pay off old investors, but was never really investing any of the money. And he would go so far as to create false investment statements and false transaction receipts to make it look like he was doing legitimate investing with the money, but it turned out there was nothing there. And even after he was convicted, he wasn't very forthcoming about why he did it and what he was doing. But there were a few comments where he said something about he didn't set out to do what he ended up doing and creating a Ponzi scheme, but he was investing money, and there was a downturn in the market in the early 90s, and he thought that he could just basically wait it out and wait for the market to recover. So he reported some basically false returns for a couple months, thinking that things would turn around and he could make the money back. And he never could, and he never did. And as the basically scheme just kept snowballing and got bigger and bigger, he probably couldn't figure a way out of it. And I think when I look at a lot of these scandals, that's kind of a common occurrence. And I think as you go into your business careers from an ethical standpoint, I don't think there's that many people that just set out to be dishonest and steal money. And some of you have probably seen the movie The Wolf of Wall Street, where there are people that are like that. But I think there's a fairly small number of them. I think most of these controversies and scandals happen when people that are otherwise trying to do the right thing, for whatever reason, think that they can cut corners for a particular, for a short time period, with the rationalization in their mind that, well, we'll make it up next quarter. Another one of the scandals from earlier in my career was WorldCom, which declared bankruptcy in the summer of 2002. WorldCom was just a huge story in financial markets from the mid 90s, up until the time it imploded. And it was known as a huge success story. They basically, a guy named Bernie Ebbers rolled up a number of small phone companies into this international long distance company, and just acquired company after company, and grew at a very fast pace. And I always paid a lot of attention to it because there was a guy named Scott Sullivan, who was the CFO at WorldCom, who was roughly the same age as me. And he became the CFO when he was like 25. And when he was 28, his pictures in the Wall Street Journal, and he's winning these awards as the best CFO in the country, and making a ton of money. And within about 3 years, he was in jail because it turned out that WorldCom essentially was cooking the books. They were making they were reporting false financial statements. And again, I think they were under probably tremendous pressure to meet earnings estimates to keep Wall Street happy. And when they got to maybe the end of a quarter, they looked at it and said, well, we think we're going to have these sales next month, so we'll just book them this month, and then we'll make them up next month, and everything will be back to normal, and we'll just do it this one time. And when you've done that once, it's probably easier than the next quarter to say, well, we'll need to do it one more time. And things just snowball, and pretty soon their financial statements were just riddled with inaccuracies and outright fabrications. And people figured it out eventually. The company went bankrupt. Both Bernie Ebbers and Scott Sullivan went to prison. Bernie Ebbers died in prison. Um, and many investors lost billions and billions of dollars for investing in this company based on financial statements that turned out to be untrue. Again, I don't know either one of them. I didn't know Bernie Ebbers. I didn't know Scott Sullivan. I don't know. I suspect that they didn't set out to commit a giant fraud, but ethically, when you start cutting corners like that, it can quickly snowball. Warren Buffett had made some comments about the importance of ethics and integrity in business, and one of his lines was that you can spend 20 years building up your reputation in the business world, and you can destroy that reputation in 5 minutes because of your actions. And I think of that because Warren Buffett and Berkshire Hathaway for a long time was the single largest shareholder of Wells Fargo stock. And after 20 years of holding it, he finally has sold most of his position over the last year or two, as I think he got fed up with what went on at Wells Fargo. But looking back at it, I have a few observations about that sales scandal that I think I'll wrap up my comments with. So the press reported the sales scandal as a way that Wells Fargo was defrauding customers by setting up false accounts and making millions and millions of dollars in fees. I don't really, well, first of all, that's not really very accurate. Not only did Wells Fargo not make money, that the whole thing was probably costing them money as a company, even if it hadn't been discovered, and they would have had to pay all these fines and had all this bad publicity. But what was happening, and this was in the retail bank branch, people that were employed there would have sales goals, and some of it was just to keep their job, but some of it was also to get bonuses. And many of them figured out that you could open up an account for a customer that they didn't know about, like a checking account or a savings account. And if that account wasn't funded, it would just automatically be closed by the system in 30 days. So no money would go in it, no money would come out, there would be no fees. And it would allow these people that worked in the branches to sometimes keep their job or sometimes earn some sort of bonus. But Wells Fargo as a company didn't profit from almost any of these. And when they went back after this whole thing became public and tried to figure out how much had actually been generated in fee income for Wells Fargo as a company through these fake accounts, it was something like $2 million. Wells Fargo's revenue is like $20 billion a quarter. So $2 billion in fees was not exactly a huge amount for them. But again, it goes back to the trust that your clients have in you, your customers have in you. And what those people were doing were setting up those false accounts was undisputably the wrong thing to do. It was dishonest. It was taking advantage of customers, even though most of them probably were not materially hurt. But I think the rationale for some of those people is that, well, nobody's going to get hurt. I'll do this for 30 days. The account will get closed. The customer will never know about it. They're not going to get charged a fee, and I can benefit from it. And again, it's just kind of the ethical shortcut of rationalizing in your mind that nothing really bad is going to happen. But we saw what did happen. Wells Fargo has been fined hundreds of millions of dollars. They've probably lost billions of dollars in business because of the hit to their reputation and the distrust that the market has in them now and their customers. 2 CEOs have lost their jobs, board members, senior executives, all because they didn't take seriously, I think, what this problem was. I think in the top levels of Wells Fargo, they also thought, well, it's not that big a deal. It wasn't very much money. We'll refund it. Most of the accounts were opened and closed and didn't hurt anyone, but they didn't take into account how important your reputation is in the business world and really paid the price for that. So I'm in about 25 minutes, which I think is maybe even a little bit more than your professor wanted me to talk about. But I think that's the underlying thing that I see when you go into your business career. Those rationalizations that some people can come up with to cut corners and do things that on the surface or at the beginning don't seem like a big deal can oftentimes end up as a very big deal. And when you're looking at in different investment vehicles and tools like derivatives, I think that you have an ethical responsibility to truly understand what you're getting yourself into, what are the inherent risks of those vehicles, and not using them as a way to avoid regulation or to avoid the rules by taking positions in things that otherwise would not be allowed, and using them the correct way and not speculating with them in a way that can cost clients and companies millions and millions of dollars. So with that, I'll wrap it up. Thank you all for your time, and I hope you learned something from this. Thanks.